Harvard-educated John Whitehead was also a Navy commander during World War II and was a part of the D-Day. He realizes Goldman Sachs cannot continue to conduct business the way it has been. The firm needs to operate like the military, where everyone must follow a code of conduct.
I wondered how all these new people that we were hiring, how they could be indoctrinated with the principles of Goldman Sachs, the conduct that we expected from our people. So on a Sunday afternoon and with a yellow pad, I wrote down what turned out to be these principles.
Whitehead also started to standardize the investment banking business at Goldman, making sure the employees put their clients' interest first.
We arrive at the meeting at 5 p.m. It's the Friday before the Memorial Day 3-day weekend, and guess what? We are sitting there waiting. A couple guys left. Okay, when the guy showed up at 10 o'clock, 5 hours late, they said, the lesson today is about waiting for people that are more important than you. And he said, someday there'll be a billionaire you need to get to. He's going to make you wait in his lobby. Okay, you need to be conditioned for that.
Whitehead's leadership not only makes Goldman Sachs more profitable, it also restores the trustworthiness in the minds of their clients. The timing, again, is impeccable. Driven by easy money and relaxed regulation, the 1980s is a decade of deal-making. Companies are eager to acquire and merge with each other, creating abundant opportunities for the investment banking industry. After overcoming countless crises, Goldman Sachs remains a force to be reckoned with. Under the leadership of John Whitehead, in 1983, Goldman Sachs makes $400 million in profit, a 60% increase from the previous year. But at the height of its power, Whitehead retires from Goldman and becomes the Deputy Secretary of State under President Ronald Reagan, and passes the mantle to Steve Freeman and Robert Rubin. Rubin built the options trading business at Goldman from scratch into a major profit engine for the firm. Now having Goldman under his control, he is confident the firm has nowhere to go but up. But he has no idea that an unlikely adversary is coming after them. In 1987, Goldman Sachs senior partner Robert Freeman is under arrest for insider trading. A few years back, Goldman Sachs was the underwriter for KKR's hostile takeover deal over the broadcasting company Storer. As an insider, Freeman indirectly revealed to a business friend the best price level to sell a call option to make a profit. Now that's classic insider trading. But you'd be surprised how many incidents like this go unnoticed. But not at this time. Robert Freeman's insider trading was noticed by one rising politician who's looking for an opportunity to propel himself to the mayorship. Rudy Giuliani, the U.S. Attorney of the Southern District of New York. But he doesn't just want to prosecute Robert Freeman quietly. He wants to create a public spectacle. So he arrested Freeman, but he deliberately dragged this case as long as he could and periodically leaked information to the media. Goldman Sachs' reputation has been dragged through the mud. For an investment bank, that could be catastrophic, as their clients may shun doing business with them as a result. But their clients decide to stick around. Goldman Sachs is really great at bouncing back from crises, because after all, their clients are American corporations, and they realize as long as Goldman Sachs keeps making them money, everything else is secondary. Rubin successfully navigated Goldman Sachs out of the black money crash in 1987 and the legal troubles during the early 1990s. Like his predecessor, Rubin also goes to Washington and becomes a politician.
He's the consummate honest broker, and Bob Rubin will be a worthy successor to Lloyd Bentsen. Bob.
By 1993, Goldman Sachs makes $2.7 billion in profit, a large part of it coming from trading. For a decade, the firm lived under the principle of putting their clients' interests first. But that is gradually shifting because Goldman Sachs' trading business is expanding to a bigger scale, composed mostly of their own money. Around that time, Goldman Sachs had about $2 billion of partners' capital, but with $98 billion of total assets. So that's a very high leverage. But the problem is that a lot of the partners are retiring and they're leaving with their capital. They need a stable base of capital that can be pulled out at a moment's notice. The solution? Going public. But there's just one problem. By 1997, Goldman Sachs has two bosses, John Corzine and Hank Paulson. It's an arrangement that has worked well for the firm since the 1970s. But as a public company, there can only be one king, and Hank Paulson knows it.
I was a competitive kid. I had a little bit of what my wife ridicules as a gold star mentality. I didn't want to just learn, I wanted to learn, I wanted to get an A.
As a devout Christian, Paulson strictly follows a code of conduct in life and business. At Goldman Sachs, Hank Paulson was known to have really loyal clients that stick with him through thick and thin. I think it's because they see him as an honest broker.
I have never been a career planner. I am ambitious and competitive. But whatever I'm doing at the time seems enormously important to me.
But Hank Paulson doesn't get along with his partner, Corzine. And eventually, the partners at the firm decide to support Paulson as the only senior managing partner at the firm. By 1997, after bringing $3 billion pre-tax income for the year, and as Paulson firmly installed as the leader, the partnership is ready to go public. But no one knows an unexpected crisis is about to ruin their IPO plan. Long-term capital management was a hedge fund started by John Meriwether, a famed bond trader at Salomon Brothers, and backed by a group of world-renowned economists.
In a moment of tremendous clarity, they realized that two risky positions taken together can effectively eliminate risk itself.
The hedge fund had an instant success, making 40% during its first year, and many Wall Street firms are competing to become its trading partner. The fund operated on perfect mathematical models designed by genius economists who studied the history of the financial market.
That's an old market rule. The market will test you and do what you don't expect it to do.
In 1998, the so-called Black Swan event happened, something that their models didn't account for. A sovereign country defaulting on its debt.
August 1998. Something happened no one had considered possible. The biggest country in the world, suddenly and without explanation, refused to pay all its international debts.
In a single day, LCTM loses $353 million. After learning about LCTM's trouble, Goldman Sachs immediately starts dumping its own bond positions into the market, accelerating LCTM's downfall. But ultimately, the Fed comes in and bails out LCTM, and saving Goldman Sachs in the process.
We expect that they're going to explain to the members of this committee why the Federal Reserve has organized the $3.5 billion bailout for billionaires, why Americans should be worried about the gambling practices of the Wall Street elites.
LTCM's failure may have almost caused a financial crisis, but for Goldman Sachs, it only matters that Goldman Sachs survives. Now, with the LTCM's crisis resolved, and at the peak of the dot-com bubble, Goldman Sachs goes public.
A big debut expected tomorrow for the Goldman Sachs initial public offering. The IPO is...
Goldman Sachs goes public by the end of 1999, selling 11% of its shares, bringing home $3.7 billion. To go public, Goldman Sachs had to release a lot of never before seen information about the company. People now realize just how profitable Goldman Sachs has been. In the 5.5 years before 1998, Goldman had made a pre-tax profit of $12.2 billion. Because of the partnership accounting, much of the $12.2 billion had been paid out to the Goldman Sachs partners. Now, as a public company, Goldman Sachs searches for more ways to make money. By the start of 2000, a new business is booming: mortgage-backed securities.
At $500 a ticket, they've come to hear how to buy their very own piece of the American dream.
You had a huge boom in housing that made no sense at all. The financing appetites of the financial sector drove what everybody else did.
By 2006, mortgage-backed securities become one of the most profitable businesses for Wall Street banks. In a span of 2 years from 2005, Goldman Sachs underwrites about $203 billion of mortgage-backed securities. At the peak of his success, Hank Paulson follows Goldman Sachs' tradition.
Good morning, welcome to the White House. I'm pleased to announce that I will nominate Henry Paulson to be the Secretary of the Treasury. He's a lifetime of business experience. He has an intimate knowledge of financial markets and an ability to explain economic issues in clear terms.
Since trading has become the main business for Goldman Sachs, the next CEO will be a trader, Lloyd Blankfein. At that point, Goldman Sachs is almost like a hedge fund. They have tens of billions of their own money, managed by their own people. Their clients begin to play a lesser role. During the bull market, the issue is less visible. But no bull market can go on forever, and their principle of putting their clients first are about to be tested by the biggest financial storm in recent history.
The news story, the mortgage meltdown.
This morning in the mortgage meltdown, new numbers showing that a record number of Americans are losing their homes.
More than 70 mortgage companies have failed in the last few months in America, and now the biggest of the big companies, the Bear Stearns, the big banks, are caught holding the bag.
What was considered to be a profitable business turns out to be a financial weapon of massive destruction.
Everybody in this securitization food chain from the very beginning until the end, they didn't care about the quality of the mortgage. They were caring about maximizing the volume and getting a fee out of it.
After the fire sale of Bear Stearns to JP Morgan Chase and the bankruptcy of Lehman Brothers, the entire investment banking sector is on the verge of total ruin. Having a large exposure to subprime mortgage loans, Goldman Sachs is among the most vulnerable firms on Wall Street.
We're faced with the prospect of a global meltdown.
Out of options, Goldman Sachs turns to an unlikely savior.
I have no idea what the stock market's going to do next month or 6 months from now. I do know that the American economy over a period of time will do very well, and people that own a piece of it will do well.
Warren Buffett's investment gives Goldman Sachs some breathing room. To recoup from the trading loss, Goldman Sachs not only unloads the mortgage-related assets, but also starts betting against them, using a type of financial derivatives called credit default swaps.
Goldman Sachs figured out before other firms that trouble was coming. They began to figure out in December of 2006, and they made a big proprietary bet against the mortgage market.
You shouldn't be selling junk. You shouldn't be selling crap. You shouldn't be betting against your own customer at the same time you're selling to them.
From Goldman Sachs' perspective, their argument is that if a client wants a type of derivative, they will create it for him. But the actions of Goldman Sachs' trading department are separate. The 2008 scandal is just the beginning of Goldman Sachs' deteriorating reputation. Since that, Goldman Sachs has been caught in multiple illegal activities. Even with all of that, Goldman Sachs emerges unscathed, and its clients are still with the firm. I think the secret to Goldman Sachs' success is that it's exceptionally good at spotting money-making trend and simply executing it better than others. And when the bubble bursts, they're quick to cut losses and bounce back. Whenever there's a boom, Goldman Sachs is always among the first to ride it. By 2018, America finds itself on the precipice of another booming market, driven by retail investors. As companies like Robinhood offer free commission trading, retail investors are flooding the market, driving the growth of consumer finance. Goldman Sachs sees this as a new opportunity to cash in.
2020 has seen the rise of the retail investor, and now Goldman Sachs, the firm known for catering to the rich, is preparing to offer wealth management for the masses.
Investing can be an important part of creating the life you want. So we'd like to introduce ourselves.
We are Marcus Invest, an automated way to invest from Goldman Sachs.
It is now 2022, and the world has changed. But for Goldman Sachs, it's still the same hungry, opportunistic company.
They have got the most formidable internal culture of commitment and teamwork of any organization in finance in the history of the world.
In the game of the survival of the fittest, Goldman Sachs has managed to outlast the majority. It's a firm that is highly disciplined and efficient for one thing: profit.